How about the FOMC minutes that were released this week? You did a write-up and I posted that in my market thoughts. Want to hit on that? Any additional comments?
Yeah, look, so the Fed's argument or justification, it seems like, for commencing a rate cutting cycle is this idea of real rates being too high, and as inflation falls, they should be cutting rates in order to, not be adding restrictiveness to the economy, right? So inflation falls 50 basis points. If they do nothing, then real rates are rising by 50 basis points. So they need to actually cut rates by 50 basis points in order to maintain the similar amount of restrictiveness. That's been the logic that Williams and Waller have kind of intonated, and I think people have really run with that concept. Now, I think there's an error in that because the overall economy really doesn't operate based on real rates. I mean, there's been plenty of segments in the economy that are impervious to these rate hikes for reasons that we've discussed. And so this idea that the Fed's going to be cutting because of real rates had led to a significant loosening of financial conditions.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
And if you recall, what I was mentioning in my tweet, in my note, is that in September, when financial conditions were tightening aggressively and the bond market was selling off for a variety of different reasons, the Fed had come out and basically said that the long end was starting to do some of the work for the Fed, and that maybe that meant that they wouldn't have to do as much tightening. And so they actually added the word financial to the statement in September, basically saying financial and credit conditions are tightening and may have an impact, which was them acknowledging that, financial conditions were tightening. Fast forward to this past meeting, I thought it was possible that they would remove that word financial from the statement because it was no longer clear that financial conditions were actually tightening. They actually have been loosening quite aggressively. And so now they didn't take the statement. They didn't take that word out of the statement. But what they did do in the minutes, which I picked up on yesterday, is in the first paragraph of the minutes, they basically said financial conditions have loosened significantly. And so in my view, the Fed minutes are not like just some willy-nilly, summary of what happened. The Fed minutes are a communication tool that the Fed uses to express a view. And so by elevating the importance of financial conditions loosening, and they mentioned it later that many participants were concerned that financial conditions loosening may negatively impact their ability to get inflation back down to 2%. This is the Fed kind of coming out and pushing back against the market, significantly loosening financial conditions. And so that was what I was referencing. And so I thought that's why, in my view, the minutes were a little bit more hawkish than people may have originally thought. This was the Fed's, one of the ways the Fed tries to push back against the market. So again, as financial conditions tighten, we will get kind of risk off type behavior. And so this is the way of them saying, look, you market have put in 6 rate cuts, you market have put in cuts in March. We're not really there. So, and we're going to this is how we're going to let you know. You market, go do what you want with it. And I think the market will continue to kind of react accordingly, particularly if the data comes in better than expected tomorrow.
So we also had, though, just deterring, right, the tax gains and selling first of the year, very typical behavior. We also had that prior to the November and December 2021 high, started off January with, a pullback. So we now have had 3 solid days of selling in the winners. Value has also kind of maintained, but at the same time, small caps are getting hit. I know your puts are very productive. How long do you think it's going to go? I'm looking at right now a buyback, the S&P 500 buyback blackout area, which also helps this selling. But we haven't really picked up into key levels where we're going to have forced selling. We've had, for the most part, gentle selling to start the new year.
Yeah.
Even though it was a dramatic first day, you know, historically speaking, we don't normally start off with a bang, with a down tape 1.8% in NASDAQ. But for the most part, this is going to lighten up, right? So we've got this blackout period for another week, and then earnings starts to kick off in 2. So what's your thinking right now in regards to the Fed minutes being released that kind of tried to communicate, hey, you're taking this a little bit too far, versus the blackout period and flows to kind of kick off the year, options expiration coming up for January, lots of leaps come off the board.
Yeah.
What's your duration? How long do you think this is going to last as it relates to pullback?
Yeah, look, we've talked about this timeline the last few sessions and last few times we've chatted just about the December expiry, year-end expiry, January 17th expiry, and kind of the cadence of what may happen and how supportive flows are kind of through this period, and there's a lot of option buyback activity, and there's a lot of reasons why flows would matter over macro for most of this period. It doesn't mean that macro can't matter. It just means at certain different times the bar is higher, and you need more adverse macro to overwhelm the flows. And so I think what we got is, there had been a view that we could just have a Santa Claus rally and kind of run things through to the middle of January OPEX. And I know, Jem Carson had been out there saying that, look, he is, he's obviously very well followed, and people kind of view him as a bit of a guru on options. And he's nailed a couple of the turning points over the course of the last year plus, almost to the day in and around options. And he had been kind of talking about these supportive seasonal flows that would last all the way through January 17th, which is the January OPEX for VIX. And I guess that maybe the 19th is for the stocks, because, again, there's all these in the money leaps that will keep the market bid kind of through that period of time. But as he likes to say, knowledge is vol, dampening. And so it's like, well, the more people that knew that, the more we've kind of front run that. We ran that playbook really through the end of the year. And so when you walked into January, it seemed like we had already largely traded kind of all of that. We got above 4,800. We really, we did a lot of that work. And so when you kind of come into this year, the other dynamics in play are the buybacks, which you mentioned, right? More companies go into buyback blackout as we push through into the middle of and end of January, and to the chart you showed before. Basically, buybacks are closed now for all intents and purposes, and will be closed for the next 3 weeks or so. So we don't have that incremental buyback support.
Fuel.
The other thing we have is that we had vol control funds, and we've had CTAs do an extraordinary amount of buying over the course of the last 2 months, and both of them now. And I think I put a chart I mentioned this morning in my chat, and I put a chart in from Tier 1 Alpha, just showing that these systematic flows have been enormous over the last 2 months, and basically are very close to the highs again. So we've already seen a lot of that systematic flow come into the market, which now, as volatility starts to rise and markets start to become a little bit unanchored, you can start to get some selling. So you've lost the buyback flow, you're maxed out on vol control and on CTAs, and you kind of, the way that options kind of work, we got dealers have shifted from a positive gamma regime to basically now into a negative gamma regime, right? So we're ticking all the boxes now of an environment from a flows perspective, which looks similar to what was created in August and September of last year, of all these things moving in the other direction. So that's
but that's
a concern. I think that's what. So we've lost the flow element, which means that the macro is not supportive for risk, then you have the potential for large risk asset corrections. And I think the macro that I'm looking at now is a market that has priced in this immaculate disinflation and imminent Fed rate cutting cycle, which I don't believe is going to happen. And now we're starting to get evidence that that's not going to happen as the odds of March start to come down. That's removing Fed liquidity. And so you have macro negative, flows negative, potential for a much bigger correction. And I just add, the last thing I would add is earnings. And look, I mean, typically what we get in earnings is we get, a lot of these early reporters come in poor, and then the market gets concerned, and then the later reporters kind of revise lower expectations. I think we're just starting now to get some of these. We had Mobileye today, which was basically a disaster. We had FedEx before the break. We had Nike before the break. We had Oracle before the break. A bunch of names not delivering on the earnings front. So if we don't get the early reporters, putting up decent numbers, then you have you have the wrong way macro, the wrong way flows, and you have the wrong way on earnings. So I don't see how markets can go up in that environment. That has me incredibly concerned. I think, what I was saying last month is I would expect markets to be lower by the middle of February. I just didn't know if we were going to make a high December 15th, December 31st, or January 17th. I just knew that by February, I thought we were going to be lower. And so that's what I was focusing on when I was buying puts last week, was like, I think let's be out in February, where I think, and I don't have to really deal too much with whether or not we start the year, super positive. Obviously, we've started the year, fairly negative.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.